The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening. Hi, Dane Pimble here from Own Financial Planning, and joining me today is Julian Campbell-Wood, Portfolio Manager with Resolution Capital, to talk about the opportunities in global real estate. Hi, Julian.
Hi, Dane.
Thanks for joining us. So could you start by tell us a little bit about Resolution Capital and kind of what opportunities you're seeing at the moment?
Yeah, sure. So Resolution Capital is an Australian-based listed real asset manager. It's been managing Australian REIT securities for over 25 years now between Resolution Capital and the predecessor firm, and then global listed real estate since 2006. More recently, we've launched a global listed infrastructure strategy as well. So focused on listed investments in the real asset space, and again, a long-term track record in the Australian market. It's largely owned by the portfolio managers and team that run the investments, who are also substantial investors in the fund. So good alignment and a long-term track record managing REIT securities.
Fantastic. And perhaps now sort of to talk a little bit about some of the opportunities you're seeing in global real estate at the moment.
Yeah, so the opportunity set for us is listed global real estate, and it's a very diverse opportunity set of major markets around the world. Often people think about commercial real estate, they think about office, industrial, and those traditional sectors. But really, when you look globally, it's a much more diverse range of different opportunities that you can invest in, ranging from data centers through to healthcare real estate, through to residential housing, logistics, self-storage, medical office buildings. So a very diverse range of commercial real estate, which is supporting the growing areas of the economy and often with secular demand trends. So whether that's supply chain realignment, digitization, the aging demographic and the needs that that's creating for real estate. So the snapshot here we're showing you, this is over 70% of the current Resolution portfolio. And again, areas that are focused in secular areas of the market with landlords having good pricing power, so they can grow rents and grow cash flow over time. So again, rental housing, necessity-oriented retail real estate, healthcare real estate, which is somewhat different to what people would experience here in Australia, in that it's all rental cash flow driven, seniors housing, medical office buildings, and that's enjoying very good operating conditions in the US, given the aging demographics, given the supply constraints. And then through to things like data centers, the explosion in AI demand and what that's meaning for data centers. So, relevant areas of the global real estate market, 95% offshore exposure. So, outside of Australia, again, providing that diversification for clients to offshore markets. And importantly, we get a lot of questions about office real estate and how much is in office, given the challenges that property type is facing in certain markets. And the direct office exposure is about 4%. And that's in markets where you're actually seeing pretty good operating conditions, like Tokyo, where vacancies 5%, or the West End of London, where it's 5%. So there's still pockets within the listed markets where office is functioning relatively well, but again, relatively small part of what we're investing in at the moment, with the core of the portfolio there.
Yeah, fantastic. I agree. That's a common misconception that we often come across as well around the role office fits in global REITs in totality. Maybe also, if you could share a little bit just around, from a valuation perspective at the moment, kind of where are global REITs sitting relative to historical norms?
There's a couple of key points that we've been highlighting for clients around the valuation, the opportunity we see in the sector at this point in time. And firstly, the snapshot we're showing you here is the relative performance versus global equities, which it's rarely been at these levels. And we're not saying that these are the same environments, and there's definitely differences here, but it's clearly been a relatively difficult period for listed real estate as it's adjusted to significantly higher interest rates, and clearly a lot of attention and capital has been focused in AI and tech and other areas of the market. But these things don't go forever, and the listed REIT sector has actually endured this increase in interest rates relatively well, in that, yes, values have adjusted, but cash flows have kept growing. And the underlying fundamentals of the sector are actually in pretty good shape. And by that, we mean occupancies are high, and importantly, new supply, so the construction of new buildings, is actually at pretty reasonable levels and declining quite quickly. And the reason for that is you've had a pretty significant increase in construction costs. Anyone in Australia or elsewhere who's been trying to build a house would appreciate how much construction costs have increased, and values have actually fallen for most commercial and the property types, 15 to 20%. So it's been an unusual dynamic where you've had your very high construction costs, values falling, yet the fundamentals of real estate are actually pretty solid. And we haven't had this sort of environment for quite some time. So that will help to underpin the returns for landlords. So rents will either need to grow, values increase, or you just won't see new supply. And that's a very constructive environment for landlords to have, because it helps to underpin the rent, cash flow growth, and then the return profile for the real estate. So we're quite constructive on the outlook for the sector. It has been a relatively lackluster period given the adjustment to interest rates and what's gone on. But as we look ahead, we think the sector is pretty well positioned and work through what's been a difficult few years.
Fantastic. Thanks for sharing that. And moving across now specifically to RCAP, are we able to talk a little bit about what are the costs involved, how is it structured, and how's it performed historically?
Yeah, so RCAP is really just another access point to our listed global real estate fund, which, as you can see, was launched in September 2008, somewhat auspicious timing. But RCAP really gave investors efficient access to this strategy via the ASX. So they can buy units via their normal broker. So they'll pay whatever their broker fees are to make that trade. And then the fee structures are the same as they are for our global listed fund. So it's got long-term track record since 2008. The strategy has been run consistently since that point in time, with largely the same team. So I'm the new one, if you like, who's been there 11 years. So you've had a consistent approach in terms of the way that strategy has been run. And over the longer term, the expectations for real estate portfolios should be in that high single-digit range. A combination of a 4% dividend yield, and then that sort of 4 to 5% growth in earnings and cash flow over time. Now, obviously, we've been through a period where that's not been the case, but again, we think the sector's relatively well positioned. And for an appropriate holding period, that should be the longer term expectation in terms of returns for the strategy.
Yeah, I certainly agree with you there. And what role do you typically see RCAP playing in investor portfolios?
So listed real estate provides access to really high quality real estate in a liquid, transparent form. But it is a listed investment, so there is the volatility that comes with that. But it is a diversification tool. So you're getting exposure to global markets. So 95% of the investment is offshore. So diversification from the Australian market and a different return profile to equities and bonds that you would get. So we see it as diversification, both by the underlying product, but also regionally, and offering a different return profile, which is underpinned by a healthy dividend yield and should grow and compound returns over time.
Fantastic. Thanks very much, Julian. And if you'd like to learn a little bit more about how we incorporate the global REITs theme in our asset allocation strategies, and in particular RCAP, you can contact us at ownfinancialplanning.com.au. Thanks for listening.